The SBA just made the two biggest changes to small business lending in 25 years, eliminated automated credit scoring, and doubled the loan ceiling to $10 million. But 60 to 70% of businesses who apply will still get denied before a human ever sees their file. The difference between the businesses who walk through the July 4th window and the businesses who get locked out is one thing: how they prepare their business profile. My name is Justin. I'm not your typical CPA. I focus on business growth and finance. Let's go. I'm going to give you one number and I want you to sit with it. 60 to 70% of SBA loan applications fail before they ever reach an underwriter. Not denied by a person, rejected by the system. The file never makes it to a human being. And among the 30 to 40% that do get approved, 25 to 50% of those approvals are reversed before closing. Conditionally approved, then killed in the final review. Now here's why this matters right now in June 2026. On March 1st, the SBA eliminated the SBSS score, the automated credit scoring algorithm that lenders have used for 25 years to screen applications. That system is gone. In its place, manual commercial underwriting. A human being is now reading every line of your D&B profile, your tax returns, your bank statement, everything. And on July 4th, 2026, just 26 days from now, the SBA doubles the cumulative loan total to $10 million. That's the biggest expansion of small business capital access in a generation. The businesses that walk through that window are the ones who prepared their file. The businesses that get locked out are the ones who didn't. This video is your file preparation checklist, and I'm going to show you exactly what lenders see in manual underwriting and exactly what your file needs to survive. Check it out. Here's how most small business owners approach SBA funding. They've been running their business for 3 years. Revenue is solid. They Google SBA loan requirements, find a lender, fill out the application, upload whatever documents they have. Last year's tax return, a P&L they threw together, a few bank statements, and then they wait. And the email comes back declined with no explanation, no feedback, just a form letter. Here's what they don't know. Their file never reached an underwriter. It died at the first screening layer, the lender's internal credit box. The DMB profile had 2 trade lines and a paydex score of 48. The bank deposit didn't match the P&L revenue. The utilization on business credit cards was 82%. The global DSCR came in at 0.89. Nothing was wrong with the business. Everything was wrong with the file. So you spent 3 years building a profitable business and 45 minutes building the file to prove it. The file just lost, and it wasn't even close. For 25 years, the SBA used the SBSS, the Small Business Scoring Service, an automated algorithm combining your personal credit, business credit, and application data into a single number between 0 and 300. If your score was above 165, your file moved forward. If it was below, you got denied. Automatically, no human, no appeal. On March 1st, 2026, the SBA eliminated it. Lenders now run manual commercial underwriting, which means a credit analyst reads your actual file, every page, every number, every inconsistency. So here's the catch, and NAV nailed this in February. Lenders are still using the SBSS internally because their systems were built on it. The score isn't gone. It's just invisible now. You can't check it. You can't fix it. The only defense is to build a file so strong that no internal scoring model can kill it. On May 18th, 2026, the SBA issued policy notice 5,879,058. Effective July 4th, Independence Day, qualified borrowers can now access up to $10 million in combined SBA financing. 7A loans for working capital, equipment, and acquisition, up to $5 million. 504 loans for commercial, real estate, and heavy equipment up to $5 million. Stacked together, this is $10 million. Now, Forbes covered it in an article on May 21st. They said the SBA loan limit is doubling, but it won't matter for most small businesses because the limit is increasing, but access is not. The businesses who prepared their files 12 months ago walk through. The businesses who show up on July 5th with an EIN and a prayer, they get locked out. Before I give you the checklist, you have to understand the 3-layer approval formula because the file you prepare for layer 1 is completely different from the file that survives layer 3. And most business owners prepare for none of them. No SBA rules govern it. Every lender has a different credit box. A file declined at Bank A could be approved at Credit Union B. Same business, same numbers, just a different lender. That is why lender selection is not a pricing decision. It's an underwriting decision. Know your bank's credit box. E-Tran, CAIVRS, OFAC, these checks fire the moment your application enters the system. They are non-negotiable. A CAIVRS flag, a defaulted federal student loan from 15 years ago, that kills the entire deal. Nobody tells you it was the CAIVRS check. You just get denied. And if you don't clear CAIVRS and OFAC before you apply, you're just gambling. Layer 3 underwriting plus committee. This is where 25 to 50% of approved files get reversed. Layer 3 is where the file gets stress tested. The credit committee debates every risk factor. Conditional approval means the lender intends to approve, but the file hasn't survived the full committee yet. And 25 to 50% of conditionally approved files get reversed. Not because the business got worse, because problems in the file were always there. They just hadn't been reviewed at layer 3 yet. So here's your 7-point file preparation checklist. Number 1, your Dun Bradstreet profile. The first thing they pull, the first thing a credit analyst pulls is your D&B report. Not your tax returns, not your bank statements. Your Dun Bradstreet business credit profile. If that profile has 2 trade lines, a PAYDEX score below 70, and a credit limit summary that looks like a rounding error, the analyst has already formed an opinion before they even open up your financial statement. Number 2, global cash flow and DSCR, the formula that decides everything. DSCR, debt service coverage ratio, the single most important number in your entire SBA file. It tells the lender, does this business generate enough cash to cover its debt payments, including the new loan, with room to spare? Here's where most business owners get surprised. It's global cash flow. The lender adds your personal debt, mortgage, car loan, personal credit cards to the business debt. Global DSCR equals your net operating income divided by all business debt payments plus all personal debt payments plus the proposed new SBA loan payment. Lenders want 1.25 or higher. Below 1.15, the file almost certainly gets declined. Below 1, and you're done. Number 3, deposit behavior versus reported revenue. The consistency trap. This is where most files die at layer 3 than almost anywhere else. The lender reviews your last 12 months of bank statements. They total up deposits. They compare that to the revenue on your P&L. They compare that to your tax return. All 3 numbers need to tell the same story. If deposits are 20% below reported revenue, you get flagged. Unexplained gap. If deposits are 20% above, you get flagged. Potential unreported income. The deposits total need to match reported revenue within a reasonable margin. Utilization. What your cards say about your cash position. Every business and personal credit card you have gets reviewed. Utilization, the percentage of available credit you're using, tells the analyst one of two stories. Below 30%, this business owner manages credit responsibly. Above 70%, this business is running on plastic and needs a bailout. Number 5, tax return reconciliation, the number one documentation killer. The number one reason conditionally approved files get reversed at the last minute. The tax return says one number. The P&L says a different number. The application says a third number. None of them reconcile. The committee reverses the approval. The business owner never finds out why. Here's the truth most CPAs won't say out loud. The lender uses your tax return income to calculate DSCR, not your P&L, not what you tell them, the tax return. If you minimize your taxes last year, the same minimization just reduced the income the lender uses to qualify you. You cannot tell the IRS you made 80,000 and tell the SBA you made 150,000. The tax return wins every time. Number 6, CAIVRS, OFAC, and affiliation, the invisible killers. 3 automated checks fire the moment your application enters the SBA system. You cannot negotiate them. You cannot explain them. You can only clear them before you apply. CAIVRS is the federal database of defaulted government loans, student loans, prior SBA loans, FHA mortgages. One entry is an automatic denial, no exceptions. OFAC is sanctions screening. Even a false name match can freeze your file indefinitely. Affiliation rules, if you own multiple businesses, the SBA may combine the revenue and push you above the size standards. Run the analysis before you apply. So here's the action. Check your CAIVRS status, check OFAC, free public database. Run SBA affiliation test on every entity you own. Do it this week. Number 7, the lender match. Choose the right lender before you apply. The single highest leveraged decision in the entire SBA process, which lender you apply to. A file declined at a national bank with a 680 minimum credit score and 2.0 DSCR floor could get approved at a community bank that specializes in your industry. Lender selection is not a pricing decision, it's an underwriting decision. So here's 3 questions to ask every lender. 1, what's your minimum credit score for SBA 7 approval? 2, what DSCR do you require for businesses in my industry? And 3, do you hold the loan or sell the guaranteed portion on the secondary market? Question 3 tells you whether the lender holds the loan or sells it. And a lender who sells behaves differently in underwriting. Know which one you're talking to. If they can't answer these 3 questions in 10 minutes, wrong lender. So here's the big picture. Let me tell you why I made this video. A business owner in this community had a $180,000 commercial cleaning contract signed, real. He needed $40,000 in equipment to fulfill it. He applied for funding and he got denied and he lost the contract. He told me one day, Justin, I think about it every day. I didn't lose the contract because the business wasn't real. He lost his because his DMB profile was thin. His DSCR came in at 0.94. He didn't have any file preparation failures and business failures. And right now, in every city in this country, there are Black-owned construction companies, Latino-owned logistics firms, veteran-owned manufacturing shops, women-owned businesses, profitable, growing, serving their communities, completely locked out of the SBA system, not because their businesses aren't viable, but because their files aren't prepared. Because nobody ever sat them down and explained the 3-layer funnel, the DSCR formula, the CAIVRS check, and the DMB Paydex score. The SPSS is gone. The $10 million window opens in just 26 days. And the playing field has never been more level. But more level doesn't mean accessible. It means the businesses who know the rules can now compete. And the businesses who who don't are still locked out. This community was built to close that information gap. The checklist is in your hands. Start item 1 today. Let's go. So before you go out and you apply for that SBA 7A and 504 business loans up to $10 million, remember the 3-layer formula that we just went through and the 7 different strategies to building out your business profile before you go get funding for your SBA loans. So if you gotten any value, drop a fire emoji in the chat and remember to hit that like button, smash that subscribe button, leave a comment. It helps the algorithms. And to your success. Salud.